Okay, welcome to the August 2nd edition of the Fats, Fuels, and Oils webinar. We got a lot of stuff to cover today, so we will get right at it. What we're going to talk about this week is we're going to talk a little bit about UCO and yellow grease and the joys of forecasting UCO and yellow grease supply and demand. And then we'll talk a little bit about what's going on in the weather and how that relates more broadly to the feedstock markets and the Inflation Reduction Bill, and then go through our usual look at the economics of biofuel production. So let's start with the weather and what's been going on. Soybeans sold off really sharply on Monday, due in part to a slight improvement in the weather outlook. The weather models got a little bit rainier for some of the drier portions of the Corn Belt from the noon model on Friday to over the weekend, I guess, to the noon model on Sunday. The market's reaction probably was more than just the weather, though. I think there was also just some general risk off selling based on Speaker Pelosi's visit to Taiwan. And one of, I suppose, the potential moves that the Chinese could make would be to slow or reduce their buying of U.S. agricultural products. Although if you look at Chinese soybean futures, they've been on fire lately. And so I'm not sure that, given the drought in South America, I'm not sure that they have a choice. Basically, soybeans went down to the 200-day moving average and then bounced off that, and now are sort of hovering around the November contract is sort of hovering around the $14 level. That's important for soybean oil because you saw soybean oil follow soybeans up and then follow soybeans down. And soybean oil is down again today. What I talk about in the weekly commentary this week for soybeans or soybean oil is the fact that I made some changes to the forecast this week, some pretty substantial changes, including changes to our forecast for biofuel consumption. And that ended up raising our ending stocks above 2 billion pounds for 21-22. And I think that at the beginning of the marketing year, if you had said on August 1st, you're going to expect soybean oil stocks to be above 2 billion pounds this year and actually to sort of grow modestly year on year. And I'll bet you $100 that that's going to be true. I think I probably would have taken the other side of the bet and maybe even given you odds on the other side of that bet. But here we are, and that's the truth of the situation. And I think that's important because this now is the second consecutive year where everybody has really expected soybean oil stocks to tighten pretty dramatically, and they haven't by the time that we've gotten to the end of the marketing year. And so now I think that the market itself, the traders in the market, are in a mode where they are going to want to see a meaningful reduction in soybean oil stocks before soybean oil has a chance to go up and potentially test the highs that we saw earlier this spring. That probably is not something that's going to happen in the short term, depending, of course, on the weather over the balance of the summer. If it remains hot and dry through the end of August, then we may get that before we get a move down in stocks, just because I think it will become maybe not obvious, but there's a couple of ways I could see changing the balance sheet so that soybean oil stocks still remained high. But in the longer term, I think that, and what I write about is I'm going through sort of a rethink about next year's balance sheet and what that looks like, and how do I sort of maximize soybean oil stocks. Since the last couple of years, that seems to have been probably the smarter move than the approach that I took. And the difficulty with that is that there just aren't that many moves left that I can do to maximize soybean oil stocks. So I've already taken exports down. I've got non-biofuel use limited, and I've got exports at a level that I honestly am still, even though it's significantly lower than it was before these changes, it still is probably relatively high compared to what we're actually going to realize. And so it does feel like 22, 23 is going to be the year that we do see a drawdown in soybean oil stocks, although again, this is the third year that that it has felt like that. I say all that to kind of say that while weather is going to continue to play a really important role in the price of soybeans and thus the price of soybean oil, I think if you just sort of hold everything else constant, that soybean oil prices and more broadly feedstock prices probably are in sort of a wait and see mode before they can start to move higher again. So for renewable diesel producers, biodiesel producers, or any end users really, I think typically what I would be saying right now is this is a great time to take advantage of low prices and extend coverage. But given this change in the way that I'm thinking about it, I don't know that there's any great need to rush out and extend your coverage. Now, that could all change tomorrow or in the next week if the maps go back to just blisteringly hot and dry over all of the Corn Belt through the end of August. And I still think that's a possibility. If the way that I look at the maps, the ridge moves around a little bit, but the ridge is kind of always still there. And the placement of the ridge is something that the weather models generally good at, but not down to the precision of, well, it's going to be over the center of Iowa or it's going to be 400 miles west. I don't think that they are. I don't think that they're good enough at that I would say 10 days out, you can sort of take as gospel wherever the models say the ridge is going to be, it's going to be. I think the more important part there is that the ridge is still there. And as long as it's still there, there's some risk that it's centered over Iowa. And so while I would say that that you probably have time to extend your coverage, you really need to pay close attention to the weather maps over the next couple of weeks, because we're out through sort of the middle of August now in terms of how far out the weather maps go. By the time we get out through August 30th, we should have a good idea of what a lot of pod filling is going to look like, and the market is likely to react to that. All right, so let's talk about UCO. So this week I wrote about UCO, and I wrote about what the latest, our interpretation of the latest data from yesterday's fats and oils report. And then at the bottom of the article, I talk about the fact that we are in the middle of sort of reworking our model for UCO / yellow grease production. And the reason that we're doing this is because the model that we've been using had worked really well, I think, up until sort of the last several months. And in the last several months, what we've seen is that we've seen a pretty big increase in UCO use in biofuel production, to the point now where basically the last 2 months, the implied UCO use in biomass-based diesel production has been above the supply that our model is suggesting. And so you can do that for maybe a month or two, but the difference is significant enough that I think that this is something that's probably going to continue. And that tells me that we probably need to rework and rethink how we think about UCO production and how we sort of split UCO production versus yellow grease. The difficulty in doing this in part is because USDA doesn't really report anything about UCO. They report this yellow grease category. And so we have one set of data that we kind of use to anchor our projections, but changes in our forecast for UCO also imply changes to our forecast for yellow grease. And so finding that balance is a little difficult. And it also means that unlike something like soybean oil, where I basically get from some governmental agency most or all of the components of the balance sheet. And so what I'm trying to do there is just anticipate what those agencies are going to report. I don't necessarily have to worry about how the soybean oil balance sheet sort of fits together and looks relative to another balance sheet. Like I don't have to worry about how soybean oil looks relative to canola, and changes in soybean oil don't necessarily mean that there are changes in canola, although sometimes it does. But that's not the situation with UCO and yellow grease. There isn't really any data to fall back on. And so a lot of this is just estimating numbers that we think make sense from the perspective of the little bit of data that we do get, also from the perspective of conversations that we have with people in the industry, and then also just from a perspective of, does all of this kind of fit together nicely, and does it sort of seem like it should work? And like I said before, if you have use in one category of demand that is above your supply for a couple of months, that suggests that maybe everything isn't working perfectly. So there will be some changes to our yellow grease and UCO balance sheets. I'm hopeful that the changes won't be really significant. Like I'm not trying to double our UCO production or something like that. I'm hopeful that the changes will be sort of 10% or less in terms of production. But I will keep you updated on the changes that we make. And if there is anybody that has a really strong feeling or opinion on where they think UCO production should be, and they look at my numbers and they say, oh, those are just crazy, please feel free to reach out and let me know. Because again, part of the process of doing this is talking to people in the industry and getting a sense of what they think. Doesn't mean that we take their numbers just as gospel, but it's definitely an input into our process. Beyond that, prices kind of stabilized for both UCO and yellow grease last week. They're down a little bit from the highs, not as much as some of the other fats and greases, but all of them kind of have come down over the last couple of weeks in sort of the more typical delayed reaction to the move in soybean oil. Very few of them have come down as much as soybean oil has. I think maybe DCO is probably the only one that's kind of close to where soybean oil is. And we expect that that prices kind of move sideways or maybe drift a little bit lower here. Again, that's partially dependent on the weather in the Midwest and what soybean oil prices do. And then ultimately, I think towards the end of the forecast period, we have prices kind of recovering back. I don't know that they get back up to the highs that we saw this spring. But again, I think by the end of next year, I think the feedstock situation looks a lot different than it does now. And stocks across the feedstock space are probably significantly tighter than they are today. Okay, so then let's talk about the Inflation Reduction Bill. And there are really two parts of the Inflation Reduction Bill that are important for the biomass-based diesel industry. One is an extension of the blender's tax credit at $1 through the end of 2024. That is something that we expected to happen. We didn't really expect it to happen this early. So historically, that tax credit has been extended retroactively, I guess is the best way to say it. The last time I think they went almost 2 years without the tax credit before they extended it retroactively. Before that, it was typically sort of sometime during the year that they extended it, and then they extended it back to the beginning of the year. So it's quite unusual to get that level of certainty this early on, and I think that'll be good for anybody that's trying to build or finance a new plant. They're able to use that additional revenue in their projections, and in good just generally for the industry to kind of know that that's where that tax credit's still going to be available. The other credit in there is a new credit for sustainable aviation fuel, and it's $1.25 a gallon, but it can go up to as much as $1.75 per gallon, depending on the greenhouse gas reductions. I don't know the full details of it yet, but it sounds like sort of an LCFS-like program where the CI score of the producer will determine what level, what value of credit they get. But sustainable aviation fuel is really small in terms of production at this point. I think in the longer term, sustainable aviation fuel is something that, as more and more of the commercial fleet turns to electric vehicles, sustainable aviation fuel is kind of the next step for the biomass-based diesel industry. And so from that perspective, this is kind of the first step in that process that ends with sustainable aviation fuel kind of carrying the bulk of the production, or at the very least a significant portion of the total production of biomass-based diesel and renewable diesel. And so anything that kind of speeds the increase in productive capacity is likely to take up more feedstocks. Again, sustainable aviation fuel production is so small, less than 1 million gallons a month generally, that at this point, whether the credit's there or not is not really going to have a huge impact on our forecasts. But again, I think that it provides some stability, and it provides some incentive for the expansion. And so from that perspective, it should be a good thing for the industry. Now, the one thing that I would note in terms of sustainable aviation fuel and feedstocks is that at least some of the new sustainable aviation fuel capacity that is planned to come online, or that is coming online, is sort of this, they call it waste ethanol. It's alcohol to jet fuel kind of technology. And so from that perspective, there will be at least some moderation of the impact on the demand for fats and greases or other traditional biomass-based diesel feedstocks. Right now, I think that the vast majority of sustainable aviation fuel capacity, or capacity that could produce sustainable aviation fuel, is more typically sort of a renewable diesel capacity, and the ethanol to jet fuel capacity still is relatively small in the grand scheme of things. And that's just me thinking anecdotally back to our list of plants that are going to come online, when they're going to come online, and what they do. So I think that while that's a positive, especially in the longer term, it's not something that's going to have a significant impact on our forecast in the short term. It may raise our forecast for sustainable aviation fuel production more quickly than we're predicting right now, although we have a a relatively aggressive build out schedule built into our production forecasts over the next couple of years. That expansion isn't that big. It's big relative to whatever production is going to be this year, but in terms of compared to biodiesel or renewable diesel production, it's still relatively small. All right, with that, let me go through, and I guess I should have had this up earlier. So you can see our forecast here for yellow grease, kind of stable, a little tick up here at the end of the year as feedstock demand increases for biofuel production, and then kind of low and then starting to tick up as we expect stocks to tighten up in 2023. Very similar outlook for UCO, although I guess we have a little bit of a tick up. There must be a seasonal thing here that suggests prices move a little bit higher for UCO, but I would say sort of generally sideways, maybe a little bit lower through most of the forecast period. Again, if 2 weeks from today, the weather maps have a big center of high pressure located over the middle of Iowa, and that's expected to go through the end of August, then these forecasts will probably look very different and probably will go up and to the right. All right. The other thing I guess that I should mention is that last week we also got the quarterly LCFS update, and just generally LCFS biodiesel production, I think totaled around, it was just below 70 million gallons. That was about 21% of total EMTS production for that period. Conversely, bio or renewable diesel production was 77% of EMTS production, and that was that was 320 million gallons. In terms of feedstocks, tallow was the most commonly used feedstock during the first quarter, about 900 million pounds based on our estimates. Tallow was used in fuel that ended up in California's LCFS program during the first quarter. UCO was second at, I think it was around 700 million or a little bit above that. Soybean oil was 556 million pounds, and soybean oil accounted for, I think it accounted for 5% of the biodiesel feedstocks and 19% of the renewable diesel feedstocks. And that trend has been kind of moving lower over the last couple of months. CARB just started sorting soybean oil into its own category for renewable diesel. And what we've seen is sort of that percentage come down slowly during the last, I guess, 3 or 4 quarters that they've actually been reporting soybean oil use or production from soybean oil. We expect that trend probably continues through the end of 2022 and then starts to reverse in 2023 as we theoretically start to hit the limit on fat and grease supplies. Now, the key thing to think about there is that CARB is considering a volumetric cap on fuel that is derived from vegetable oils. And so if they do that, we'll probably change our forecast around a little bit, but I think then there will also be a question of, will there be enough fuel available to the market to meet their goals? My initial reaction to that is probably yes, that if you take basically all of the fat and grease fuel and put it into the market and send soybean oil every place else, that's probably kind of how it works. And so I don't think, at least initially, that that cap would be a problem, but I haven't taken a deep dive into that. And so again, that's sort of my my initial reaction. We also get the EIA's EIA's estimate of renewable fuel excluding ethanol production for May. As you can see in the chart, it was up a little bit from April. This was the first year this month that production was actually below our forecast. If you remember last month, after several months of production being above our forecast, we'd raised our forecast quite a bit. And so now we're just going to kind of fine tune that. But you can see we generally expect that production is around here, a little above here through the end of the year before we get to the seasonal uptick in November and December. All right, for gross margins, we saw both renewable diesel and biodiesel margins, or our estimate of those margins, tick down this past week. The move lower was more pronounced for biodiesel than it was for renewable diesel. That's due to the rally in soybean oil prices, and that there was sort of a double whammy there because fuel prices also came down or sort of continued to come down. I think the week-to-week gap, or the week-to-week decrease in both biodiesel and renewable diesel prices was one of the largest that we've seen certainly in a little while. And so that also kind of cut into margins. Now, biodiesel margins fell to I think in the 58-cent range or somewhere in there. Yeah, I think 58 cents. No, that's out a little bit. 68 cents, I guess. Sorry, I was off by a dime. And renewable diesel fell to 2.31. You can see from the chart, we expect biodiesel margins to kind of remain pretty close to here through the end of the year and into next year before, again, lower fuel prices and steady to maybe a little bit lower feedstock costs start to eat into margins. For renewable diesel, we expect margins to come up through the end of the year, just a little bit above where they were. We expect them to kind of average about 250 or a little bit more than 250 through the end of the year, and then next year we expect them to come back down a little bit again as fuel prices fall and feedstock costs stay close to the same or maybe a little bit lower, but not as much as we're predicting fuel prices will fall. So obviously, if fuel prices remain close to current levels, then our forecast would look a little bit different, and we would be predicting margins probably pretty close to current levels out through the end of 2023. Although, again, I think there's probably a tick up in feedstock cost someplace maybe near the end of 2023, where that starts to eat into margins, even if fuel prices remain relatively close to the same. In terms of our RIN price forecast, we really didn't make significant changes this week. We cut RIN prices by about $5 to $10 across the entire curve. That may seem a little counterintuitive based on the rally that we saw in soybean oil prices anyway. But that is kind of what the models wanted to do, and kind of where the market was over the past week kind of suggested that cut. But in general, not a big significant change. I also wanted to show this chart today. Okay, so this chart looks a little bit different here than it did because that's from 3/1. Okay, sorry, I'm going to have to look at this chart. If you look at the real chart, basically what it shows is that the HOBO spread sort of bottomed last week and then started to tick back up this week, but still remains below last year. And so again, maybe the move in the RIN forecast is a little counterintuitive if you think of it in terms of the HOBO spread. But the changes weren't that dramatic really anyway, and maybe we were a little bit higher the week before than we should have been. For credit prices, this chart is pretty much unchanged. I think next week, if prices kind of continue to remain a little bit weak, we saw some weakness in LCFS credit prices relatively early this week. If prices continue to do that, I probably will cut the near term forecast, the forecast for the next quarter, basically by about $5 a metric ton, but still think that generally the shape of the forecast probably remains the same. I think last week or the week before we talked about this idea that part of at least the pause or the stabilization in LCFS credit prices may have been around the headlines of the headlines around the CARB meeting that suggested that they were going to make some changes. And since those changes aren't even going to be finalized till the end of this year, there's some risk that maybe now the market starts to move lower again. That may be the case, and we'll kind of see what happens with prices over the next week or two. If they continue to move lower, then what I'll think is that the market is going to wait and is sort of discounting the potential for CARB to make these changes, and probably will flatten out the forecast a little bit. I still think once the changes are made that, or once it's apparent that changes are made, that you get this move higher in credit prices. All right. With that, if there are any questions, please do the usual thing. If not, there is somebody that wrote in and asked a question about capacity versus one of our charts, and I'm not sure if I see them on the call today. They're generally on here, but I don't know that I see them, but I still will kind of explain it just in case anybody else has sort of a similar question. Their question was around sort of the implied capacity from the EIA data versus the charts that where we show production, and they referenced the production from last month at 136 million gallons against renewable diesel capacity that the EIA reports, and wondered about the disconnect between those two. And it really is it's that in the chart we're showing production, we're not showing capacity. And so the 136 million gallons wasn't a theoretical production number that they could make based on capacity. It was the actual reported data, and the capacity numbers are a fair amount above that. All right, now we've got a couple questions. I observed your UCO, DCO, and canola oil average annual forecasts for last week were 5, 5, and 7 cents lower than the week prior. Unless I was mistaken, can you share the key drivers for the reason for these forecast reductions? So it was the idea that before that, we had talked about this idea that that maybe we were at sort of this theoretical limit on the supply of fats and greases being used in biomass-based diesel production. And if that was the case, we didn't know whether I didn't know whether fat and grease prices were going to follow soybean oil lower. And I'll include canola in that primarily because canola oil also has a It's only a little bit used in biofuels and more used in non-biofuels, and there was a drought last year, and so canola oil was kind of is in relatively short supply. So I treated all of those kind of the same as what I'm trying to say there. And the idea was that if we are sort of at this theoretical limit and we're using up as much of the fats and greases that are available, then the move lower in soybean oil prices wouldn't necessarily trigger a move lower in fat and grease prices, like it had historically. Historically, we see a move lower in soybean oil prices, and then 4 to 6 weeks later, we'd kind of get a similar reaction in the fats and grease prices. And so soybean oil sort of dropped off a cliff, and traditionally I would have lowered the fat and grease prices to reflect that move lower in soybean oil. But because fat and grease prices kind of stuck around their records for a while after the move lower in soybean oil, I started to think, okay, well, maybe we are at this limit, and I think we will hit that limit one day. But then we saw fat and grease prices start to move lower, and so basically I adjusted my forecast more along the lines of how I would have traditionally moved the forecast. And because I waited, the adjustment was a little bit bigger than it probably would have been if I had kind of been doing it along the way as soybean oil prices moved lower. Now, all of that said, my soybean oil price forecasts and more broadly my feedstock price forecasts have all moved by 5 cents, 7 cents, both up and down, unfortunately, over the last couple of weeks. And I apologize for that. There's nothing that I hate more than making big moves in my price forecast. Not that I don't have to do it sometimes because something changes, or because there's some new information that changes my outlook on the market. But generally over the course of my career, I've never had to move prices around as much as I've had to move prices around in the last couple of weeks for these markets. Now, the markets have been volatile, but my job really is to try and see through that volatility and help you understand where the true value lies. And if I'm doing that well, then that doesn't necessarily include 10-cent price swings in my forecast from week to week. But excuse me, unfortunately, it has over the last couple of weeks. And I think we're back on track now, and I feel much better about where we are forecasting now. But again, we are entering this period where the weather looks potentially menacing to me. And so it may be that there are more big adjustments coming up over the next 3 or 4 weeks. I would say I think after the next 3 or 4 weeks, I will have a really good handle on where I think prices are going to go moving forward. And then hopefully, even if the market remains as volatile as it has been, I still will be able to give you forecasts that don't jump around by 10 cents a week. Do you have a price outlook for choice weight grease? Yes, we do. And let me do this, since I don't think I did this last week or last time somebody asked about this. So if you go to the fats and oils forecast, and on this side you'll see forecast, and if you pick up choice weight grease, there is our forecast going forward. Now, unlike UCO in yellow grease, choice weight grease looks like it has a bit more of a seasonal tendency to be stronger later in the year. There are probably a couple of reasons for that. One is the growth in in biofuel feedstock demand towards the end of the year as production increases, and then the other is the seasonality in hog slaughter. So my guess here is that the reason that this outlook is a little bit different than the outlook that you saw for yellow grease and UCO is due to that combination, is that here in the short term, essentially we expect it to be kind of sideways. But then I think, and I'm trying to remember back to my days of covering the livestock sector, when the peak in hog slaughter is, and if I say it, I'm quite sure that I'll get it wrong, so I won't say it. But from the way that the price is forecast, my assumption is that supplies are probably relatively lower in the early winter than they are in the summer and spring. I think that's the way that it goes, but I don't remember. It's been more than 10 years, amazingly, since I've really covered hogs. But if you ever want to know the choice white grease price forecast, that is how you find it. The report states tallow is the most commonly used feedstock, accounting for 907 million pounds of use during the quarter. Is this for RD or biodiesel or both? Considering the limited pretreatment for RD plants, can it really be the largest feedstock source today? So it's for both renewable diesel and biodiesel. The way that we calculate the estimated feedstock demand is CARB reports gallons produced using a specific feedstock. And so what we do is we take whatever that number is, and then we multiply that times our yield, and that gives us our feedstock estimate. So I think you could maybe say that our yield is too high or too low. It takes too many pounds of tallow, or we say it takes too many pounds of tallow to make a gallon of renewable diesel or a gallon of biodiesel. But even if you disagreed with that, we wouldn't be off by more than probably a pound or so at the most, and so that wouldn't necessarily take the tallow used in production down from 907 million to like 300 million or something like that. You also have to remember that there are renderers that can deliver tallow that is on spec to renewable diesel producers, and so it's not just the pretreatment capacity that tends to determine feedstock use for the fats and greases. The other thing probably to remember is that California and the way that they produce it, the way that their numbers work, we compare it to domestic production, and certainly a lot of the production is domestic production, and a lot of the volume is domestic production, but it all doesn't necessarily have to be domestic production. I'm not aware, honestly, of any foreign producers that would be shipping into that market that use a lot of tallow, or tallow is their main feedstock source. But there may be a little bit of that in there. I don't really think so. I don't think that there's that much. And then the final point that I'll make is that we have seen, just in terms of total tallow supplies, and this kind of will go back to may shed a little bit of light on what we're going through with our UCO price forecast. We had a model for tallow imports that was working really, really well up until basically a couple of months ago. And we had to go back and adjust that because US tallow imports started to pick up pretty significantly, and we're coming in well above our forecasts. And so what that says to me is that I'm not surprised. Well, I was a little surprised that tallow was number one. I'm not surprised that tallow is one of the top one or two or three sources of feedstocks for the LCFS program, given that it's a fat and a grease, and so it has a lower CI score generally than the vegetable oils do. Higher than UCO, obviously, but UCO then has its own challenges. All right. Oh, one last question. Snuck it in right under the bell. Where can you find the data on feedstock usage in biofuel production? So there is, the only place that really tells you feedstock data for biofuel production is the EIA. And traditionally they provided feedstock use in biodiesel production. And then a little more than a year ago, I guess at this point, they switched it to feedstock usage in renewable fuel production. And so the good part is now we get a picture of all of the soybean oil used, or at least I guess the soybean oil used in biomass or biodiesel and renewable diesel production. Apparently co-processing is not counted in the EIA numbers. So you get a maybe a more complete picture. The bad part is that they don't separate it out. And so you kind of have to separate it out into renewable diesel and biodiesel. And the way that we do that is we kind of go through and we take a first pass at separating it and make sure that whatever the numbers are, they make sense from a recent history kind of thing within the single commodity. So soybean oil use in biodiesel doesn't go from 50 million pounds to 500 million pounds, and same for renewable diesel. That all kind of fits together. And then we go back and we look across all of the commodities and make sure that they all sort of seem to fit together for any particular for renewable diesel or for biodiesel. But if you do a search on EIA monthly feedstock report, I think that should get you to the spot that you need to go. If you can't find it, send me an email and I will send you a link. All right. With that, then, everybody have a great week. Thank you so much for attending, and I will be back next week. There is some very, very, very small chance I might not be around next week. I've got jury duty on Thursday. Hopefully I can get out of it. I guess there's some scenario that I'm trapped in jury duty through beyond my report date, which is Thursday. But hopefully I can get out of it. But if not, I will let everybody know, and we will still post the report, but we may not have the webinar. All right. I look forward to seeing everybody next week. Have a great week. Bye-bye.